Welcome to Empower Leaders, our monthly series bringing together the most senior leaders in the industry to address today's unprecedented challenges in investment management. Today, we are focusing on leaders in ESG, and we have a jam-packed hour of headline asset management CEOs and CIOs, the most innovative new data providers, and tough analysis from leading commentators. To start this off, I'm absolutely delighted to introduce Jag Alexeyev, who's head of ESG Insights from Broadridge. And he's going to give us both the numbers and the context about where the money's really going in ESG and the prospects for asset managers in this fast growing and really complex market. So, Jag, welcome.
Thanks, Jenny. I'm glad to be here today to talk about where the money is going in ESG investing. And clearly, there's been tremendous growth in the past year, surprising growth, perhaps. We've seen net flows into ESG mutual funds and ETFs surpass 300 billion euros worldwide, as we can see in the slide in front of you. It's double the amount just a year ago, and it's 4 times the amount in the previous couple of years. So it begs the question, are we anywhere near peak ESG? How much can flows grow in the coming years? Where will assets under management go? We've already seen AUM reach 1.4 trillion euros in Europe and cross-border funds. What's interesting, actually, is that in the last few months, we've seen that the Sustainable Finance Disclosure Regulation probably makes the universe actually a bit bigger in Europe. Many companies have come out under the SFDR and designated several funds previously not tracked as ESG as Article 8 products, which promote ESG characteristics. But regardless of how big the segment is, clearly there's tremendous momentum behind it. And there are, of course, a few things driving it. There's a mindset of accountability. Investors, asset managers, asset owners, they all want to know what they're doing with their money and what their money is doing for them, but in particular around the adverse impacts related to sustainability. On the other side of that, you have a greater awareness by all those parties involved about the importance of sustainability and ESG factors on company returns, on corporate issuers. How do financially material ESG factors affect the long-term shareholder returns and the risk and characteristics as well of investments in them? So this risk part of it is quite important. Very high on that list is climate change, of course, but in the past year, we've seen other ESG and sustainability issues come under the lens, human rights, supply chain. So there's much that's driving this forward. What's future growth going to look like? Where can we go? As I started at the outset, how likely is 4 trillion euros under management globally by 2025? If we think about that question and ask, well, what will it take to just get there? If flows grow 20%, in the next couple of years and maybe moderates a bit to 10% in the 3 years after that, without much performance gain, we can actually get to 4 trillion. So that's number one, tremendous growth, tremendous momentum. Number two, while the business has grown, we've also seen client preferences shift meaningfully. We've gone away from exclusionary-based strategies that were really part of the first generation of socially responsible investments towards sustainable and focused thematic ESG products. So actually in the last year, sustainable and thematic products captured 20% of net flows in Europe and cross-border funds in the ESG space. So we've seen this big shift to sustainability. It includes renewables, it includes climate change funds, circular economy products, and also broader strategies linked to the United Nations Sustainable Development Goals. So fundamentally, there's a bigger focus on outcomes. There's a more of an emphasis on impact. But we know that there's a challenge in measuring and delivering impact through public market funds. It's one of the challenges that asset managers have to address in the coming years. And the broader implication of these changing shifts over time is for asset managers, are their capabilities up to date? Do they have the investment teams, the data resources, the frameworks to be able to actually deliver the solutions that clients will want in the next few years? One other aspect of the ESG business that's quite interesting and widely discussed is the balance between active and passive funds. And ESG has been a natural home for active managers worldwide, but especially in Europe and cross-border markets. Active still captures 70% of net flows into the ESG business. You've actually seen it rise a bit in the last couple of years. That rise has actually come away from open-ended index funds as ETFs have continued to grow in Europe. And certainly if we looked at this chart in the US, it would be even more pronounced. This contrasts meaningfully with outflows from active non-ESG products. But one interesting question behind this chart is looking forward, can passives deliver sustainable outcomes as investors look to do more with ESG passive strategies than carbon tilts or exclusions? Is ESG data robust enough to drive indexing solutions? We know that the ESG data from different providers often give different signals. What's the role of technology and artificial intelligence in helping to parse that information so that you can extract better signals, investment signals from the ESG data? And then one final aspect of active passive is the cost of integrating ESG, both in the investment process, but also in shareholder engagement. Overall, there's a lot of complexity in this business, and asset managers need to keep sight of their goals, whether they're implementing ESG in active or passive. So as all these things, dynamics occur in the background to drive the growth of ESG, how is leadership evolving? Well, if we just look at the top 10 managers in terms of net flows into ESG products in 2020, there are a few interesting things that pop up among the top 10. First of all, ESG absorbs the majority of flows for 9 out of the 10 managers you see here. In fact, 6 out of 10 had more than 100% going into their ESG products. That means their non-ESG funds were in net redemptions. So that's number one. Number two is 8 out of the top 10 firms here are based in Europe. And maybe that's not surprising because we've seen Europe to be a bit ahead of the rest of the world in the implementation of ESG. But the flip side of that coin is that 7 out of 10 of these firms remain dependent on Europe for their ESG business. 100% or more is of flows for 7 of these groups are coming from Europe. Can they globalize? Can they take the capabilities internationally? And then there's a time aspect of this table. If we compared the top 10 last year to just 5 years ago, only 3 firms in the top 10 last year were there 5 years ago. So there's been tremendous turnover. And as the business changes, as there's more intense competition, we can expect similar changes in the future. One final point I'd like to highlight today is the importance of innovation. Clearly, product development continues, but the marketplace is becoming a little bit more mature, a little bit more crowded. The menu of offerings have grown. And what we've seen is that new funds in Europe and cross-border markets, new ESG funds captured practically all of ESG flows in 2015, just half a decade ago. But that's come down to new funds capturing only about a third of net flows last year. Is this a sign of emerging leadership in the industry? Are fund selectors becoming more diligent in their due diligence? Are they becoming more selective and honing in on a few managers that they feel have the credibility, the capabilities, and the breadth of products to deliver on what their clients need? Or is the market just getting ready for the next phase of growth? And regulation, of course, SFDR and EU taxonomy and everything else will be very interesting to watch as they shake up the dynamics, both in new product development as well as competitive outcomes. I would highlight one last thing before I finish up. As we look at this business in the coming years, it would be interesting to shift the frame of reference away from products to solutions. How is asset allocation? How can model portfolios help in delivering a more holistic solution for investors to encourage long-term responsible investing? There's, of course, a lot more going on in this business, but these are a few things that I see as being key in the coming few years. Thank you.
Thanks, Jag. That was fantastic. Well, here we've got our big panel. We know that one of the biggest challenges for CEOs of asset managers is how to build and scale an ESG-led investment business from the top down, meaning how do we incorporate the complexities of credible, transparent data for investors and regulators across the whole enterprise? To answer this question, we've got an incredible lineup of leaders, and I'm really thrilled to introduce our panel today. We've got Lionel Eishliman, CEO of Mirabaud Asset Management. We've got Niels Bolmstrand, CEO of Nordea Asset Management. Peter Branner, CIO of APG Asset Management. Mary Cherry, who is EU Regulatory Counsel and Chief Sustainability Officer for Compliance Solution Strategies. Peter Fletcher, Chief Revenue Officer for Clarity AI, and George Latham, CEO of Web Asset Management. You cannot get a better panel. So before we start, if you want to ask a question, just tap the button on the right of your screen, and if we've got time, we'll ask those at the end. So let's start. So where are we now? What would you say are the biggest challenges for you in building a credible business-wide ESG business? Niels, let's start with you.
Jenny, and you touched upon it. I think you touched upon data. Data is definitely one of the major obstacles to overcome when ESG goes mainstream. I think and when we're talking about data, it's corporate data. So it's having access in a reasonably standardized format data on companies, on the impacts they have on ESG issues, and being able to, in an easy way, collect and then use our data capabilities to crunch this data. The other part, which I think is equally important, is that although we've been incorporating this for 30 years in our business, more or less, as the asset management, but I still believe that we're at the beginning of this. It's nascent. We now have customer preferences. We have a regulatory framework that is predominantly European, and I think we're likely to see this evolve even further. We will create market standards. We will create industry standards. And before those are set and we know the customer preferences in this, it will also be it will be difficult to scale it, and it will be much more about being able to satisfy the demands that we can see by using what we inherently have built up as historically in our own right.
Great, thank you. Peter, what is your view of the biggest challenge for you in building a credible ESG business?
Thanks, Jenny. I think that the biggest challenge is that everybody expects us to be sustainable, but it brings different perspectives from different people. And I think most of the industry around us expects sustainability to include exclusion of companies, and only that. So the biggest challenge for me is to convince everybody around us that the dialogue with companies is much more important than just throwing out companies that are not doing well. Because if you do that, you lose your influence and you're not able to get the company to do what you want them to do. So I think by far that is the biggest challenge we have. Then, of course, there's also data that we will get back to. But those two elements, I would say, are the biggest issue.
Great. Thank you. Lionel, you're the CEO of asset management of a large private banking group. What's your perspective?
Yes, thank you very much, Jenny, for the question. Yeah, I'll talk about data, and we'll talk about, IFRS and other needs for research in a minute. But at this stage, I'd like just to take a step back and say a little bit who we are and where we come from, because it's important to give the right light to this discussion later on. Mirabaud Asset Management is a young asset manager established less than 10 years ago, managing about 10 billion of institutional monies. But as you said, it is part of a much broader private banking wealth management group established in 1819, that is more than 200 years ago. Today, we represent the 7th generation of partners. So having this partnership and this history, this heritage behind us has given us always a very strong sense and culture of sustainability, responsibility, and long-term view, long-term approach. Just as an anecdote, when I joined the group 10 years ago as a managing partner, I asked my partners what should be my mission. And they said to me, well, Lionel, you have to convey, to transmit the group to the next generation, even stronger and better than it is now today. So, I didn't know whether that was or just a light touch job description. But upon reflection, I thought it was extremely deep and profound, because it was exactly conveying the sound and healthy message that sustainability, long-term view, responsibility should be at the heart of everything we do. And not only for the house itself, but also for the products, the portfolios, the mandates, and the funds we manage. So today's main challenge, I would say, is not to rest on this heritage and on this history, but really to be at the forefront and to remain at the forefront now that things evolve quicker than ever in all these fields, and as entrepreneurs remaining, at the top of all these developments and making sure that, we look not towards the past, but toward the future. And when I say future, I don't mean tomorrow. I don't mean the next quarter, but really the next generation.
Yeah, great answer. And George, you're CEO of a boutique asset management firm specializing in sustainability and ESG. So you come from a different perspective. What's the challenge for a starter when you've got that mission from the beginning?
Thank you, Jenny. Yes, so Web Asset Management is a single strategy investment boutique which specializes entirely on sustainable investing. We have a long-term, long-only global equity strategy, which is focused on investing in companies whose products are solving sustainability challenges. And we're looking for lockstep relationships between positive sales growth and positive impact. And yes, as you say, we started with 20 million under management. Today, we're at 1.2 billion sterling under management. So the challenges have changed really over that period, over the last 10 years or so. I've been operating in the sustainable investment market for 25 years, and for many years the challenge was that no one really wanted to listen. We were the odd bunch on the side, if you like, and now suddenly the noise you have to shout to be heard. And I think there is a challenge around enabling new entrants to come into market. I mean, we've been lucky. We've been able to be a resilient organization that has become established and has become a sustainable business in this space, and that's fantastic. We're phenomenally lucky, but in this market, there is a need for an innovation, and the barriers to entry in the investment market per se are very high. It's very difficult for a new investment organization to become established. Those have been the challenges over the last years. Now the challenge is managing growth and the explosion of interest in this space. The challenge is there's a multitude of different approaches to this topic, and the need for clear and consistent communication about what any strategy is trying to achieve. And sometimes talking about the challenge of greenwashing based on the use of language. But I think there's one perspective. I think that your initial question is about the challenge of scaling, and I think that one of the things I might push back on is that scaling for its own sake is not necessarily the right or the only objective. Because sometimes it's more important to ensure that strategies are run at appropriate scale to achieve the best impact and the most positive outcomes from a sustainability perspective.
Okay, thank you. Mary, we'd love to hear from you. I think what is so interesting coming from a data company such as Compliance Strategy Solutions is that you're seeing exactly what the challenges are for your clients. Could you briefly tell us what you see?
Sure. So Jenny, at Compliance Solution Strategies, I think the biggest challenge for our clients is what we've already heard, which is the need for data, and more data, quality data. The challenge is sourcing quality ESG data and also integrating that data. So for some clients, it's a completely new exercise. But even for those clients who are more like some of my co-panelists and have been thinking deeply about these issues for some time, in the context of the EU regulation, they will be obliged to pay attention to new categories of data under the SFDR. So in terms of sourcing, how do you get the data? To what extent are you relying on your own efforts, as in surveys or direct engagement? And for which metrics could you possibly use third-party data providers? And I know that David is going to talk to us about that. I'm looking forward to his comments. On the question of integration and what to do with the data once it's sourced, how will it feed into your regulatory processes? Those are the kinds of questions we're focused on, in particular into fund documentation and reporting workflow, and the overall strategy for integrating ESG data into existing compliance systems.
Great, thank you. David, Clarity AI are at the forefront of using AI to build credible data. What are you finding that your clients are saying is their primary challenges?
Yeah, thanks, Jenny. So we're a technology company, and we're in ESG, sustainability, and impact all day, every day, particularly impact these days. And what we see is the challenges our clients are facing, they're common across all of our different segments, whether it's a client who's a large asset manager or a small financial advisory firm. And they're sort of threefold really on the data side. First, the data tends to be fragmented and non-standardized, coming from multiple sources. Secondly, it's often unreliable information and often with conflicts, even for the same metric. And thirdly, you often find incomplete coverage of issues in industry sectors because of limited reporting at the corporate level. And that sort of range of problems is actually one of the reasons why Clarity AI exists. So one of the problems we're solving for is entirely focused on the data challenge. So what we've done is we've built the largest and most reliable database of environmental and social impact data. So we now cover more than 29,000 publicly traded companies and over 220,000 funds. And the way we've done this is we've done it by aggregating and cleaning structured and unstructured data, and we've complemented it with estimation models to fill the gaps. So these are some of the problems clients come to us with and some of the problems we're trying to solve for.
Great. And that kind of takes us on to the second question is about kind of going a bit more detail into ESG and the new regulation. And Mary, where are we now with regulatory developments, SFDR, and the recent metrics?
Yeah. Well, the SFDR, as we all know, went into effect on the 10th of March this year. And at that time, only the level 1 text was in final form. So firms' compliance was high level and principles-based, to use the regulators' words. And the most visible outcome of this stage was the product classifications. Firms classifying the greenness of their offerings under the now famous labels of Article 6 for not green, Article 8, light green, and Article 9, dark green products. And now we await the final version of a key document, the level 2 text of the SFDR, the regulatory technical standards that will give us the exact content and form of disclosures, Since the initial draft, the industry has been a buzz, buzzing around these disclosures. They are data heavy. They're asking for concrete metrics to be disclosed in mandatory templates. And this text will be the blueprint for the industry's work for the coming 2 years. And so sometime soon, perhaps around the 2nd of May, we expect the Commission to accept or amend the Level 2 text proposed by the ESAs. Now, for now, we have the ESA's, the European authorities' final draft to base our preparations on, with the expectation that the ultimate text will be very close to this draft. And once final, then we expect the Level 2 to go into effect on the 1st of January, 2022. So the upcoming disclosures require a high level of specificity at the product level for Article 8 and Article 9 products. 2 templates have been developed, one for pre-contractual documentation and one for periodic reporting. And each template involves a mix of qualitative narrative style questions and also quantitative data points. At the entity level, there's what might be considered controversial principal adverse impact statement designed to quantify how a firm's investments adversely impact sustainability. And the PAIS, as it's known, has landed on 18 mandatory sustainability indicators, specific data points, with monitoring on up to 46 additional optional indicators. It covers a wide range, from greenhouse gas emissions to board gender diversity, water usage. If we take all of the indicators together, the mandatory and optional indicators, we're looking at a wide breadth of ESG topics. And so we have an opportunity, perhaps, for a step towards standardizing ESG data, but there are still many gaps, both in the regulatory definitions and also in the available data. And then one final point is that the Level 2 text will almost immediately be revised again to incorporate the ESA's proposal on taxonomy-linked product disclosure. So the timing is a bit messy with all of the moving parts, and will continue to be for some time. But the good news is that in the end, there will be a single template for SFDR and taxonomy-linked product disclosures.
Yeah, that is fantastic, isn't it? David, as a tech platform, serving some of the leading investors in sustainability, what do you think investors can do to comply with new regulations such as SFDR? What is the best advice that you can give them in this context that Mary's also been explaining to us?
Yeah, it's interesting because it's an ever-evolving landscape, isn't it? And what we're certainly seeing from the client side is that the investment community is still very much deciding which is the best way to address the challenges, particularly around things like SFDR that they're having to face. I mean, most are coming to the conclusion they need to rely on some sort of third-party service provider. It's fair to say some are still debating whether they should try and aggregate multiple service providers themselves or just rely on a single solution. Now, in terms of advice, so a cornerstone of any regulatory reporting initiative, and I'll use SFDR as an example, is the coverage and the quality of data is paramount. So there's very little else to really consider as the first step. And when Clarity first started and we built out our tech platform, we adopted a multi-provider view, and we carry out reliability algorithms on top, quality and the highest coverage. Now, what we found is the investment management world, they're demanding comprehensive solutions that allow them not only to comply with the piece of legislation that is SFDR, but also with the other directives such as EU taxonomy or TCFD in the UK that we have at the moment. Plus, there's a lot more coming down the pipe. So we actually see very few people out there who can provide the full package. And our actual approach is very much on the data reliability side. And that focus has been reinforced by the likes of Nordea Asset Management, who've chosen to work with us as a collaboration partner on the SFDR initiative. So again, my advice, if I'm allowed to give any, is think about data reliability.
Yeah, great, thank you. So bringing the rest of our panel in, for you asset manager leaders, how are you in practice addressing these data challenges, and to what extent can you develop your own solutions, and what are the limitations or what are the benefits? Going straight to you, Niels, as you've been name checked here.
Thank you so much. First of all, I think we need to separate between what's regulatory reporting and what's our core business, which is managing money. And I think for both of these areas, we need data. The regulatory reporting is much more prescriptive, and we can use and buy data in a format that allows us to do the regulatory reporting. I still think that it is target, but we have previously. But then we have the core of what we do, which is delivering outcomes to our clients and the investment processes. This is what we live and die by. And there, I think we can do more. There, I think it is about the engagement with corporates. It is about finding also proprietary data that you can use for your investment processes. And I very much second the previous speaker saying that one of the big challenges here is to get the market and to get a holistic view of that engagement is something good and something necessary, because at the core of what we're trying to do here is that we're trying to create a shift. We're moving from something to something. And in that, it is about helping and being a partner to the investee companies in making that shift as well. And there, I think, again, it is increasingly important for us to be able to be data-driven and to help them as well in finding metrics in what they should relate to when they create that shift and that movement. And that takes a lot of resources and a lot of professional resources in-house in order to be able to do so.
Yeah, sure. Thanks, Niels. Lionel, I know that you are interested in talking about homogenization and standardization when we come to this. What's your detailed action points?
Yes, actually, it's a very interesting debate, and I agree with Niels. We all face the same issues. We need data that is reliable. We need data that is comparable. We need data that is homogenized, standardized in many respects. And we need probably IFRS, standards to evolve to include things which are not currently accounted for in the, or priced. What is not priced does not exist, but properly valued, like externalities or things like this. But for us, at our size and in our day-to-day work, we use both internal and external research very concretely. So we rely, on rating agencies and on data providers, on research houses, MSCI, Sustainalytics, Beyond Ratings, Trucost, and the like, to try to bridge the gap between the need for good ESG disclosures on the one hand and what we get from the companies and from the corporates. And the larger the corporates, the more data you get, the smaller, the small caps, small and mid caps, the more difficult it is. And many companies are poorly rated, not because they behave badly, but because they don't have the resources or the knowledge or the skills to give the right data. So we have to distinguish between all of that. So the third-party research is extremely valuable. It is of very good quality, and it is progressing, of course, and getting better and better. But we are in an industry which is increasingly regulated, and there is a growing, a growing tendency towards standardization everywhere. And standardization is good in many respects. We need a common framework, we need common definitions, we need common terminology, but standardization can also lead investors towards, how do we call them, tick the box approaches. And we, as responsible active managers, we don't like these tick the box approaches. We think they are too narrow. We think they often, do not integrate rightly and at the right level the materiality of the ESG risks that are, relevant to each company. And for these reasons, we use all these databases and these things and research as a guide, and then we do our own work. We believe that homogenization should be, the word instead of standardization, because standardization leads to having just one book on the shelf. And intelligence is not about having one book on the shelf. We should keep diversity, We should keep different perspectives, a wealth of views and intelligences. And when you have full standardization, it kills diversity, it kills intelligence, it kills innovation, whereas homogenization fosters innovation in many respects. And we as fundamental, active, and responsible investors, we feel that all this data, all these standardized things will never be a complete substitute to doing our groundwork of research, analysis, and as Neil said, of engagement with the corporates. In a corporate democracy, we have to play our role of active investors and engage with the communities we live with, and help them, bringing change as well.
Oh, I accidentally switched my mic off. George, can you tell us a bit more about the practicalities of addressing greenwashing, which is, I know, something that you're really engaged with?
Yeah, I think the important thing from our perspective, I agree with a lot of what Lionel was just saying there. We start with our investment thesis, and the data and the methodology that we use needs to fit the purpose that we want it to work for. So yeah, absolutely. We develop, for example, we're particularly interested in the impact of the products and services of the underlying companies in our portfolio. And so we've developed a tool which we call the Impact Engine, which analyzes and interrogates various different dimensions of positive impact, what it means. And to do that, we drew on the work of people like the Impact Management Project, the Future Fit Foundation, and created a tool. There's no equivalent tool externally that you can buy in. We're fundamental investors, very much bottom-up researching companies for the portfolio. And we run a strategy which has 45 holdings. So there's a real contrast with what I think it was David was saying earlier, where he's looking for 29,000 public companies. We want deep data, we want the right data, we want the material data that we're trying to achieve with that portfolio for 45 companies, not 29,000. So although, as you said, coverage and quality of data is all that's important, I think the materiality and the purpose of that data and the usefulness of that data to your own objective is another crucial importance as well. So I take some issue with that point there. And I think that the challenge that we face with applying external data or external frameworks in this pursuit of standardization is that there's a risk that it does ultimately lead to box ticking and greenwashing. If you're publishing and projecting data you're not ultimately using to make investment decisions, then your purpose is purely to tick a box for a regulatory standard or some kind of standardization framework, in which case you're not actually going to be interrogating the integrity of that data as fully as you're going to be if it's actually integrated within your investment process.
Thanks a lot. Peter, I know that stewardship integration is one of the things that you're particularly concerned about, and I've got some very interesting insights. Can you tell us a little bit more about that?
Yeah, thank you, Jenny. I think I will focus on two things. One is, of course, how the 300 or so portfolio managers we have already in our systems are able and have to actually document the four angles of investment, so risk, return, cost, and sustainability. So that has for a long time been part of the investment process, and I think that is really crucial that you have it embedded there. And all that is available for the teams to dig into later on, so that you have a good archive to validate when you do updates. The second, and maybe in this context more important contribution, is our work last year when we co-headed the SDI Asset Owner Platform. And that work, we have also signed off several very large investment management companies as clients to that system. And in a nutshell, it's basically to translate how 8,000 companies on this planet directly contribute to the SDGs. And by using AI and natural language processing, we're able to automate that sort of categorization and create a taxonomy that basically addresses the key issue that everybody has. How does this make the world better? And how can you aggregate your portfolio holdings at total portfolio level and there report to external stakeholders what you're actually doing? So we are really proud of being participating in that, and of course, signing up more and more asset owners like ourselves in this system is wonderful. And as you can hear from other participants, everybody's doing the same thing here, right? And they're not only one way, but this is the way we have decided to do this.
Yeah, great. Yeah, I love that, the asset owner networks. Coming to you, David, I know that you've been developing your Clarity AI product for years. So from your experience, why is it that asset managers and investors just can't develop their own AI solutions?
Yeah, no, interesting comment, Jenny. So basically, asset managers and investors can indeed develop their own products, as some of the members of the panel have shown. However, what we're seeing, it's particularly hard for the smaller and the medium-sized asset and wealth managers to do it, particularly because they lack the time and the resources needed to dedicate to the sustainability process. So even for large clients, it's incredibly difficult, but you really have to invest, and it's very, very resource intensive. So you need to build the technology platform to store and analyze the data. Obviously takes time and needs an expert technology team. Second, you've got to create your own sustainability expert team focused on the methodologies and sustainability, as opposed to, say, the traditional financial risk team. And thirdly, you need to develop and validate the evolving methodologies. You build the methodologies into your workflow and equip the business with the metrics to apply the methodologies that shift as new regulations come out, and regulations are constantly evolving and coming down the pipe. And then finally, what we find is that the final stage is you've got to apply all of the above in a scalable way and try and fully automate the process. So it is a lot of work to do, and it was our business. It's taken us a number of years to get there. It is difficult for everybody to do it. Some people do it with a plum. But the idea is, given how much knowledge and expertise you require to measure, tackle, and report on the different questions, it's a challenge for most people.
Thank you. So I think that kind of, we've talked about the current regulation. Mary, I'd like you to tell us a bit more about a regulation that's on the horizon, and then get everybody's view on whether they think that that is an opportunity or a threat, because it's there and it's really how we approach it strategically. So Mary, what's on the horizon?
Yeah, that's a good question, Jenny. The SFDR is, of course, only the start in the EU, and there's a lot to cover. So if we stick with the EU, first there's the taxonomy. Just last week, the European bodies reached political agreement on the first technical screening criteria on climate change. And for now, the taxonomy will not address natural gas and nuclear activities. Further screening criteria will be developed in the course of this year on the remaining 4 environmental objectives. The EU also released a proposal addressing corporate sustainability reporting. And as we've heard, this is sorely needed to address the lack of good comparable data, corporate sustainability data. So this directive will authorize a standardized set of corporate disclosures, and let's hope that they will provide for overlap with the data that's being demanded by the SFDR and taxonomy. And in any event, many more companies will be required to disclose concretely. All large and listed EU companies will be caught by the new rules. So we'll see mandatory sustainability reporting grow from the current 11,000 EU companies in scope to almost 50,000 companies. There are also changes coming to the EU financial sector legislation, MiFID, UCITS, AIFMD, et cetera. And those changes will spell out how investors' sustainability preferences are to be taken into account. And in other EU news, somewhere in the course of this year, we expect to see a draft directive on sustainable corporate governance, a directive that will impose supply chain due diligence and human rights standards on EU companies. So the EU is keeping sustainability professionals very busy, but it's not the only region focused on ESG. So I'll try to briefly give some pointers in the right direction. The UK is pushing ahead with its plans to make TCFD reporting mandatory, and it wants to do that on quite a short timeline. The last that I've heard is that the intention is that the disclosure rules will come due as of April of 2022. Across the pond, the U.S. is trending in the right direction. So with the new administration, the tone from the top is very clear. The Biden administration is active, engaged with climate policy. President Biden re-signed the United States to the Paris Accord on his first day in office and vowed to review Trump-era climate setbacks, so to speak. And this tone from the top is reflected in particular in the SEC. So the SEC has appointed an ESG head. They've created a climate and ESG task force within the Department of Enforcement. And a couple of weeks ago, they issued a risk alert on ESG with guidance and enforcement priorities relating to combating greenwashing. And then just a quick final note, in Asia, green taxonomies are on the way. Malaysia is far in its development of a green taxonomy, and Singapore is now consulting or just closed the consultation on a proposed green taxonomy that's modeled on the EU's taxonomy.
Great, thank you. We've got 5 minutes left, so I'd like just quick comments from the rest of you on whether, from a CEO perspective, CIO perspective, you see all of these changes as an opportunity or a threat to your asset management business. How do you build it into something very substantial with real edge? Lionel.
Thank you. Yes. Just maybe in order to make a full disclosure, I am a regulator as well because I sit on the Swiss takeover panel.
Oh, I didn't know that.
So when I talk about regulation, no, just more seriously, I'm sometimes surprised about the debates on regulation, whether we need more or less regulation. I'm convinced we need better regulation, and it's a question of quality of regulation and not of quantity. This being said, we Mirabeau support very much the idea that we do need ESG regulation to bring more clarity, more transparency, more visibility, hence more credibility to ESG products. We support the emerging regulations like SFDR, taxonomy, and the like. We believe that will indeed help reorient the flows towards sustainable investment, make things clearer for investors, allow to distinguish, true robust processes from greenwashing, which we again very much support. But at the end of the day, we also believe that regulation must be proportionate and practical, and not create bureaucracy, nor be careful about negative externalities or collateral unintended consequences. We don't want to kill the diversity, innovation, employment. So everything needs to be well balanced.
Thanks, Lionel. David, what's your view coming from a slightly different data perspective? Opportunity or threat?
Yeah, both really. So as Mary says, the regulations are changing in real time. I mean, obviously sustainability is going mainstream, but from a sort of software and technology perspective, we believe regulation, particularly SFDR and EU taxonomy, that they present a unique opportunity for the investment management community to build that credibility to serve clients, regulators, and even the wider economy. So there is definitely elements of the legislation that need to be sorted out. But if I were a leader on the other side of the fence, I'd be defining my technology strategy now in order to allow myself to analyze and report the sustainability dimension today, but also to respond to how the market needs, client demands, and the regulatory developments are going to develop. So if I were on the other side of the fence, I'd say it's the constantly changing landscape that poses one of the most serious challenges to the investment management community.
Thank you. So briefly, Peter Branner.
Yeah, I think, Jenny, that the biggest opportunity for all of us is really to drive this through, right? This industry has a huge obligation to help society to improve. It's transformational times, and our ability to push this is very much technology driven. And as we all know, this is not trivial. So really, my focus is now to enable the organization to use digital tools to really empower the organization to think digital and sustainability as one. And that sounds maybe as one-liner, but it is really what this is about.
Yeah, thank you. Thanks. Niels, final line from you, opportunity or threat? 30 seconds.
I think this is a massive opportunity. The world faces a number of global threats, and we see a growing population of consumers saying we want to be part of the solution to these threats, and the financial industry is a means to an end in this. We can give them the opportunity to be part of the solution, and I think that's our responsibility to do so. And then I'd like to end with that, but that does not mean that the political world can abdicate from this problem, because fundamentally it needs multilateral solutions and politicians and political solutions to it, but we can definitely be a means to an end.
Thank you very much. I'm not, George, have we got a final 2 seconds for you? George Latham, in a nutshell.
Yeah. In a nutshell, of course, it's an opportunity, and it's massively exciting because it stems ultimately from what consumers want. As Niels put it very well, if we can see this as a huge momentum for change in the shape of the global financial services industry, away from being self-serving towards serving positive outcomes for society, and that's an opportunity for all of us. And it's an opportunity for a much better purpose for the investment industry per se.
Thank you so much. Thank you so much to the panel, Lionel A. Schliemann, Mirabeau Asset Management, Niels Bolmstrand from Nordea Asset Management, Peter Branner, APG, Mary Cherry, Compliance Solution Strategies, David Fletcher, Clarity AI, and George Latham Webb. Thank you so much. That was a great session. Thank you very much for your time. Thank you everybody for listening. That's the end of the April Empower Leaders webinar. We look forward to seeing you for our next edition in May. Thank you very much.